What would I do if I start investing today with $1,000 capital? So friends, that's the question we are going to answer in this video. Thank you for joining me on this video. This is Take Investing, where we talk about investing. Please subscribe, like, share, all those things. Okay, let's get on with the video. First things first, this is an education channel. This is my opinion. Please invest at your own risk. So there are two ways you can manage your portfolio. You can actively manage it or you can passively manage it. So active management involves picking or making an active participation in your portfolio. So this involves you picking stocks, you reading the news, and then choosing to invest in a certain stock. In essence, you're making active decisions in managing your portfolio. You might trade into your account, you might trade out of certain positions. You got the idea. So I'll talk in detail about actively managing your account in the next video because this is a topic that I like, and there are a lot of ways you can actively manage your account. But in this video, the focus is going to be on passively managing your account. So let's get into that. So passively managing an account means you don't actively involved in managing your account. A good example for that is your 401k account. So normally in a 401k account, you just contribute money monthly. Initially, you might have picked one or two funds, and then it's on autopilot, right? Every month, money goes into it. The same instrument within that 401k is bought again and again, and the funds within your 401k might be actively or passively managed, but that's a different topic. For most people, a passively managed portfolio would be the perfect portfolio because not everyone would be interested in financial topics, nor interested in keeping up with all these financial topics. So for someone who has other interests, other passion, not interested in finance, passively managed portfolio is the best, because actively managed portfolio, you have to do a lot of work, especially when you're maintaining a portfolio in something like a Robinhood. You have to be aware of everything that's happening with the finance world, what's happening in the stock market, what's happening in the bond market. You have to be aware, or you are just technically actively managing the portfolio but not really doing any work, and that can affect you negatively in the future. So I would say for more than 90% of the people who don't really care about or who don't enjoy picking stocks and a passive managed portfolio is the best, and it will give them the best return, and most of the time it will give them a better return than an actively managed portfolio. So there's a interesting bet that Warren Buffett made with hedge fund managers. So what he did was, in 2008, he challenged the hedge fund industry, and he told them that a broad market-based index fund is going to outperform hand-picked funds from these hedge funds. Also, hedge funds charges management fees, premiums, and certain profit partnership on top of everything. When you compare all this combined, the SPX in US, that means it's the S&P index, is going to outperform them over a period of 10 years. And Prodigy Partners accepted this bet, and long story short, they accepted defeat in 2015. That is 2 years before the bet concluded. Why? Because SPX was massively outperforming their hand-picked fund. So having said this, passively managing a portfolio doesn't mean that you pick up anything and that you just contribute money to it. It doesn't work that way. What you have to invest is in a broad market fund so that you are reasonably diversified, and then you contribute funds to it every year or every month, however you choose to do so. And the only other thing that you'll do within that portfolio is rebalancing it, which I'll talk in a second. So now let's talk about the Fidelity study. So this is a widely quoted study over the internet, whereas Fidelity did a study of their accounts from 2003 to 2013, and what they found was funds held by people who are no longer alive performed the best, and the second best performance were the funds where owners forgot that they had these funds. So this study apparently is fake because Fidelity has never confirmed the study, but the gist of the story is true. There have been a lot of research where they checked, where they back tested different theories all the way back to 1923, and almost all the cases what they found was hand-picking stocks only had a 1% probability of success. So the SPX index was formally made in, I think, 1953 or 1958. So of course those there were 500 stocks in it. Of that, only 60 of them still remain in that fund. So what you have, 60 of those original companies are still there in 2019. So what you have to think that if someone handpicked certain stocks in 1953, well, he would have lost all his money, right? Because only 60 of them are still around, which means that if they're handpicking stocks, there's only a 12% chance, the 60 divided by 500, there's only a 12% chance that they would have picked the right stocks. So anyone who would have invested in a broad market index then would have reaped huge benefits. So I guess you get the idea of investing with an index fund, right? All the studies support that. Now let's go about creating a portfolio. So you cannot just randomly pick anything, so there has to be a particular way in which you create this account, because you want to know what's your probability of success, right? So in creating the portfolio, we are going to use Monte Carlo simulations. So what it does is it looks at a random number of samples, and then it projects results into the future. So let's quickly try to construct a portfolio. So I'm taking certain assumptions here. Like we said, our initial investment amount is $1,000, and then we contribute $100 monthly. Because, well, you have to contribute $100 monthly, right? Otherwise, what kind of investment are we doing? And then we'll keep a contribution frequency as $100, and simulation period we'll keep it as 20 years. We'll use the historical returns for creating the model, and then we will use historical inflation, because we always have to add inflation. And I've added SPY, which is the ETF which tracks SPX, and VGT, which is the Vanguard ETF that tracks the information technology stocks in US market. So I give an allocation percentage of 60 and 40 to make a total of 100, and let's run the simulation. So here we get 8.55 at the 50 percentile. So in Monte Carlo model, you get answers in different percentile. A conservative approach is look at the 50th percentile, so right in the middle. You get 8.55% of real return and 10.76% of nominal return. I'll talk about the difference between real and nominal in a second. So in dollar values, you have approximately 68K in real value, in real money, and 102 in nominal value, 102K. So the difference between real and nominal is, you're talking about a period of 20 years, right? So the value of money has changed over the 20 years. So that's why it's showing numbers in both the cases. So after 20 years, if you look at your account, it will show 102K. But what does that really mean in today's dollars, which is given by real? In today's dollar, that 102K is equivalent to 68K as of 2020 money. Hopefully you got me. So we can also look at a few other numbers, because this is all about probability, right? So we looked at the 50th percentile. So let's look at the return probabilities. That means what's the probability that we'll make a positive return? So at the end of year one, there's an 86% probability that will be positive, we'll have a return above zero. At 10 years, we'll have a 93% probability that we'll have a return above 0%. And at the end of 20 years, you're almost confirmed 98% probability that you'll have a positive return. Now let's look at some bigger numbers. So after 20 years, there's a 75% probability that you'll have a return above 7.5%. And after 10 years, 69.1% probability. And there's at the end of 10 years, you have a 56% probability that you'll have a return above 10%. So all good numbers. But what we have to be cognizant is about the loss probability, right? So let's look at that. So we won't include the money that we put in monthly. So loss probability including cash flows, 0 probability, but let's not look into that because this calculation is based on original $1,000 that we put in. So we will exclude the future cash flow. So here we have a 1.5% chance that we'll have a greater than 2.5% loss. So now what we have to think about is how to reduce this loss, right? So let's add more variety to the funds, the passively managed portfolio that we created. A quick side note, whenever you run the simulation, every time you run it, you'll find slightly different numbers. So 69,000 at this point, and when I run the simulation again based on the same factors, 69,553. Let me run the third time, 68. So the reason is every time it's randomly selecting the sample on which it runs the simulation. So that's why you get slightly different numbers, and that's the beauty of Monte Carlo simulation. Okay, let's get back into analyzing the risk with this portfolio and how to eliminate this risk. And I'll explain it using the SPX index. So we bought into SPX index thinking that we are diversifying. After all, this SPX is invested with 500 companies, right? But just have a look at what Market Watch has to say. When you buy into SPY, you're buying into a weighted index, correct? So weighted index means if companies have a higher market cap, it's given more allocation in that portfolio. So if you look here, just 6 companies represent a quarter of SPY. So if you buy $100 worth of SPY or SPX index, at 25 of that dollars is shared between just 6 companies, and that includes Facebook, Apple, Netflix, Microsoft, Amazon, and Google. And within that, just Apple, Microsoft, Amazon, and Google account for 21% of the index. So even though you thought that you were well diversified, but 21% of your money was just put in 4 companies. And the same way we set VGT, but in VGT again it's Apple, Microsoft, right? So the 10 largest holdings in that VGT accounts for 59% of the total assets. So now you have some compounding effect as well, right? Because Apple and Microsoft was weighted and was represented in the SPY index as well. So long story, let's add some diversity to our portfolio. So what I'm going to add is a bond, which is always good. And here I'm going to use BLV. BLV is a good combination of government and public company issued bonds. So if we look here, the government bonds are at a 40%, and then the public company issued bonds are 36%, and few scattered here and numbers scattered here and there. So it's a good mix of both government and public companies. Also, I'll add IAU, which is a gold fund. So let's go back to our Monte Carlo simulations and add BLV and IAU, which is the iShares Gold Trust. So now we'll have to change the percentages because all of that has to add to 100%. So I'll make this 40, and here I'll make it to 30 and 20 and 10. Combined it's 100. Let's run the simulation. So if you remember the numbers before, our percentages are almost the same. In real value it's a little above 8%, 8.69%, and in nominal values the return is 10.54% at 50 percentile. Of course there's a 10 and 90 percentile that you can look at. And also in dollar amounts it's 68,000, which is very similar to what we had before, and the nominal value of 96k. But the main reason why we added these two new instruments to this portfolio was to reduce our risk. So when you come here, if you remember, before we had 1.25%, 1.25 and above percent chance that we'll have a loss of about 2.5%. So now it's only 0.27%. So we eliminated almost all our risk of having a negative return. And let's look at the positive return. After 10 years, we have a 72% chance that we'll have above 7.5 return. And after end of 20 years, we have a 79% chance that we'll have a return above 7.5. And there is actually a 56% chance that we will have a return of about 10%. So these are phenomenal numbers, right? So I'm good with these numbers, and when you're creating your own portfolio, you don't have to stick with these particular ETFs or financial instruments, but you shouldn't have like individual stocks in it, like, you know, don't add Facebook or Google or something into it. It should be broad market based funds. And now all you have to do is buy this in Robinhood or E-Trade or wherever you are in the world, buy into the local brokerage in so and so a percentage that you're comfortable with, and the only thing that you'll have to do is rebalance your account. So what happens after a period of 1 or 2 years is we have to maintain this percentage, right? Because we ran the numbers on this percentage and we're good with this. So for us to get the numbers that we got when we started the portfolio, we have to keep the percentage at this allocation. So for that, you can do two things. If SPY grew more, and after 1 year, let's say SPY is at 50% allocation, right? Because SPY grew way more than VGT and BLV. One thing you can do is you can just sell a little bit of your SPY, sell out of it, and maintain that ratio. But that's a way I don't like. The reason is it can create a tax event. Why simply pay taxes, right? So a better approach would be buy more of VGT BLV to keep that percentage. So for example, you are contributing monthly, right? In this example, we are contributing $100 monthly. So we are contributing $100 monthly. So we can choose to just not buy SPY for 1 or 2 months and just buy VGT and BLV and IAU in these percentages. So one good thing that Robinhood and all the new brokerages gives us is we can buy in dollar amount. We don't have to buy in number of shares. So as an example, we are contributing $100 monthly, right? So each month you can choose to buy $40 worth of SPY, $30 worth of VGT, $20 worth of BLV, and $10 worth of IAU. And whenever you want to rebalance it, you can just buy $40 of VGT, $20 of BLV. You know, you got the idea, just to keep that percentage. So I hope you have a good understanding of how to create a good passive portfolio. And in this portfolio, you can it's a fire and forget portfolio, right? All you have to now do is just add this $100 every month, and if you can increase your contribution amount, great. And let's put some awesome numbers, right? So let's change this 1,000 to 10,000 and make this to 200, because I think most people can afford these numbers, right? And let's run the simulation one more time. So at the end of 20 years, you'll have, remember, you only started with $10,000. In then money, you'll have 251k, and in current money, you'll have 179k. Beautiful numbers. So that's all I had for today, folks. If you have any questions, please let me know in the comments. I'll try to reply. I'll reply. I hardly get any comments, so I'll reply. Please stay safe, folks. Stay awesome. Ciao. See you in the next video.